Okay, we'll start the lecture. Today we are going to discuss associate and joint ventures as per LKAS 27, 28, sorry, 28, LKAS 28. So we'll discuss the learning outcomes. First of all, we'll look at what the associates and joint ventures are. Then the rationale for equity methods and application, the basic principles of equity methods will be discussed, and also goodwill adjustments and fair value differences at acquisitions, intercompany transactions recorded by the joint venture and joint losses, of course, recorded by the associate and joint ventures, and the discount. Of course, out of these seven learning outcomes, today first session we will be discussing the first three part. Okay, look at entities often hold equity investment in other entities. The counting methods depends on the investment and the relationship between the investor and the investee, nature of the investment and relationship between investor and investee is crucial when deciding how to account for. The subsidiaries you learn under consolidated financial statement, SNFRS 10. You do the consolidation line by line consolidation methods. But in consolidation, in associate and joint ventures, as per the standards, LKS 28, accounting method is equity method of accounting is applicable for associates and joint ventures. But there are other investment in equity instruments. Then of course you have to follow the financial instruments SLFRS 9, either by using fair value through profit and loss or fair value through OCI. We'll discuss the associates, the particular standards. Para 3 says that the associate is an entity over which the investor has significant influence. Significant influence is the crucial factor when deciding whether it's an associate or not. Significant influence is really the power to participate in the financial and operating policy decisions of the investee, but it is not control or joint control over those policies. When you look at the associates, no control, no joint control story is coming. Only the power to participate in financial and operating policies decision is the matter. Then next one, if you look at just hypothetical data, suppose investor acquires 25% of another company, we call it associate. Investor associate. Now we don't talk about here the parent and subsidiary story. Parent is not there when you talk about the associate. We talk about the investor and investee. Here, of course, parent and subsidiary. When you say parent and subsidiary, consolidation matter is coming. Investor associates, the significant influence matter is coming. Participations as opposed to dominations, control or dominance. When you say control or dominance, it's really the subsidiary, parent subsidiary relationship. When you say significant influence, again it's investor associate relationship. When you say joint control, it is really joint arrangement. We talk about joint arrangement and joint control. It is the capacity to participate that is required, not actual participation. When you say significant influence, it is capacity participation. No need to do its actual, but capacity, assumptions. Holding 20% or more of the voting power leads to the presumptions of significant influence. So when Whether you have significant influence or not, the matter really depends on these factors. Board representation, if your members, the members from your investor side, if represent in the board, so we call it significant influence is there. Participating decision about dividend and profit retention, any material transaction between the investor and investee, any material transaction, exchange of managerial staff, provisions of or dependence on technical. You provide technical information, so you will get the technical information. Then those kind of indicators will really disclose us to understand there is a significant influence over the investor. Identifying joint venture is investor and investor B, it's joint venture 50 to 50. That means you are controlling, A and B is controlling joint venture jointly. That is the idea. Joint arrangement is an arrangement which two or more parties have joint control. Two or more parties, no need to be two, maybe more than two. Joint control exist only with decisions about relevant activities require the unanimous consents of the parties sharing control. Just we are having this, percentages, ownership is not enough. What is important is unanimous consent of the parties sharing. There are two types of joint arrangement. One is joint venture and the joint operations. We will be discussing this joint operation in our final lecture. Joint venture is joint arrangement whereby the parties that have joint control of the arrangement have right to net assets of the arrangement. Here if it's a joint venture, the investor is really having right to assets and right to net assets of the arrangement, right to net assets of the arrangement. Equity method of accounting rationale. Associate and joint ventures are accounted for using accounting methods, commonly referred to as single line method, online console, not online, line by line, not the line by line, online consultation, single line. The assets investment in associates, joint ventures is initially recognized at cost. That's important. At cost, you recognize initially, then as a single line item in the statement of financial position. The assets is the asset is subsequently adjusted for post-acquisition changes in investors' share of investees' net assets due to profitable operations. So statements of profit and loss OCI will include line for both. So there will be a line for profit and loss account, share of associate and joint venture, share of profit and profit of joint venture and associates in the OCI. So both places you get two line items. Profit and loss account line item, OCI line item, balance sheet one line item. There are only three line items with regard to the equity methods of accounting for LKAS 28. Application of equity method. If the investor is not a parent, the equity method is applied in the investor's books. That means if the investor is not preparing consolidated financial statements, if the investor is a parent, cost method is used in the investor's books and equity methods applied on consolidation. That you want to understand. If the investor is not a parent, that means no subsidiaries, no consolidations. You prepare in the books of investor equity method. But when you prepare the consolidated financial statement, the investor is the parent, then individual investors books, you prepare cost method, equity methods is applied on consolidations. Okay. Consolidation worksheets can consolidate generated subsidiaries, equity and release to the associate. Consolidation worksheets relate to the consolidation worksheet subsidiaries, equity entries relate to the associate. The entries are done on a year-to-year basis. They are not permanent entries. You have to remember. In the consolidated financial statements, we don't put permanent entries. We just put temporary entries done by year-to-year basis in not permanent basis. Initial investment in associates, investor's share of profit, that is initial investment in costs, investor's share of profit, and investor share of items of OCI reduced by distribution by investee, accounting, equity, accounting, accounted carried amount. So this is similar to partnership account. In partnership and sole proprietorship, you take the capital, you added the profit portion or the profit of the sole proprietor and you deduct the drawings. Here similar to that, but here only the difference is the profit and loss and the OCI is two components. You get one segment from profit and loss and you get another segment from OCI. So altogether you add both. If it is a profit, if it is a loss, of course you have to deduct, and of course dividends you have to reduce, then you get the equity accounting carry on. Now just for example, just look at this example, lecture example. Helper Limited acquired 25% of the voting shares of Beta Limited 1st July 2014 for 80, and at the date of acquisition, the shareholders' equity Beta is as follows. So 257 is the all assets are recorded at fair value. So you acquired 80,000 shares Beta Limited for rupees 8,000. So here what happened is basically the investment, what do you call investment in associate is 80,000. That is the consideration. Okay, and the retained earning is retained earning as fair value. That is net assets. Equity. Equity is really the 320, right? From 320, you take only 25%. From 25% means how much? Yes, 32, 64, 16, no? Altogether, what do you call 0 and 7, 8, 8. So 80 is the net assets acquired. So thereby there is no goodwill. This the 25% is equal to uh, uh, sorry 25% of equity is equal to the investment. Thereby very simple the calculations. No goodwill, and only the entry is initially you record this 80,000 at the beginning of the the balance sheet 31st, sorry, first 2014. Is it clear? Okay. Then the following information related to beta. This is also beta. The following information, that is the first year, because you acquire in the July 2013. The year end results: profit after tax 60, dividend paid, uh, ARR balance. That is of course revaluation reserve balance. LKAS prepares consolidated financial statement. LKAS does not prepare consolidated financial statement. Does not prepare consolidated financial statement. What is this ARR balance? Anyway, I don't know what is this ARR balance because it has different meaning. Shall we just cut off this one, ARR balance? Okay, what we can do is the alpha does not prepare consolidated financial statement. If alpha is not a parent under equity method, what you have to do is the initial cost is 80,000. You can remember 80,000, right? And 60 is the profit. You take 25%. 25% is of course 615, no? And dividend is 28, but our portion is 25. So you take 20 into 25, that is how much? 45 minus. So altogether answer is 9. Answer is 9. Alpha prepares consolidated financial. Even if you prepare consolidated financial statements, what happened here is when you prepare same balance will appear 18 to 15, of course minus 5. Same thing, same answer. There is no difference. You get the same answer. But only thing is, when you look at the journal entries, there's a small difference in the journal entry, right? So when you put journal entry here, the what do you call this? Alpha does not prepare consolidated financial statement. Journal entry would be initial journal entry, of course, investment account debit, investment account debit, investment, investment in associate, investment in associate, right? Investment in associate to debit. How much? 80. That's the first journal entry. And cash credit 80. That is in the alpha decimal prepare console. And dividend, dividend cash, yes, cash debit, cash debit, how much? Dividend is 5 rupees, and investment in associate credit 5 rupees. Okay, investment in associates. Third journal entry would be profit share of profit, investment in associate, investment in associate, debit 15, okay, and share of profit, share of profit will credit 15. That is the 3 journal entries in the books of Alpha. In the books of Alpha, 3 journal entries: investment in associate, cash credit, cash debit, investment in associate credit, investment in associate debit 15, and share of profit in associate 15 credit. Only difference is you put the same journal entry, but when you prepare the consolidated financial statement, what happens is you debit the dividend revenue instead of cash. Dividend revenue debit 5 rupees, dividend revenue debit 5 rupees, investment in associate, investment in associate credit 5. That is the double entry. But when you receive the cash, of course, you credit the cash and debit the revenue, credit the debit the cash and credit the revenue to the activity set off. Anyway, so that is the journal entry in the books of consult. There is no difference except this entry. Instead of cash, here you put dividend revenue, dividend revenue. That's all. But final balance, equity balance, whatever the method, Alpha does not prepare consolidate financial. Alpha prepare consolidate financial. The value same. It is same. Okay. Then we'll go to the goodwill and equity method. Of course, what we'll do is we will discuss the goodwill and equity method. Basically, goodwill is, as I told you earlier, goodwill is the difference between purchase consideration and the net assets of the fair value acquired. As per the consolidation procedure covered, there is no difference in calculation goodwill. Goodwill is the carried amount of the investment and cannot be amortized. Cannot amortize in goodwill. Excess of course on bargain purchase you will charge to the P&L. Okay. Applying the equity methods will depend on the situation of the investor's inventory, etc. That's all about uh, basic principle, but I would like to share with you the what you call the slide presentation of not the chapter, of course. The chapter I would like to share with you this information very clearly. Basic principle we have covered, same principle. This is right. ARR assets, I don't know. It's okay. But anyway, we can do this question very simply. If you look at this 25% acquired and the share capital of this is given and the profit for the period is also given, and in addition to that 4,000 dividend and transfer. But remember the transfer of general reserve, it's not a matter, we don't consider it because it's a just movement of resources. The cost is of course for 2,500, and only thing is uh, what you have to do is you have to calculate the share of profit. Since the profit is 25,000, so what you have to take is 25% of 25,000. We debit the investment in associate joint venture and share of profit or loss associate in joint venture credited. That means the P&L credited and investment account debited. So step 3, of course, the investment in associate and joint venture, share of other comprehensive income, associate joint ventures, 1,200 to 1,001. How do you get it is clearly that there is a revaluation surplus of uh, comprehensive income 4,000. Yeah, being reported in the here. The assets valuation here is 5,000. From 5,000 you take 25%. So here it's 5,000 from 25%. You get the investment in associate and joint venture. But we are not crediting this to the profit and loss. We are crediting the share of other comprehensive and dividend, of course, other comprehensive income. And once you record it in the other comprehensive, you will put the reverse entry. You debit the share of other comprehensive income and credit the assets revaluation. So automatically what happens is these two journal entries write off. These two journal entries write off. Okay. Then finally, the cash and investment, as I told you, cash account debit the 25% of the dividend and credited to the investment in associate and joint venture. That's all. That's all. So finally balance would be 49,000. Okay. Then the equity of limited of share capital so much. Assets valuation will be 5,000 uh, because it increases at the end of the first year. I'm talking about the investee. 3,000 you transfer 3,000, that is 30,000. Then return earning will be 20,000 plus 25,000, that is the profit for this year. This is the opening and minus dividend and transfers. In preparation of consolidated financial statement, as I told you earlier, only all the entries are same, but only the dividend revenue is debited and the investment in associate joint venture caters. Here, the instead of cash, you credit the dividend revenue. So that's all with regard to this. The investment in associate and joint venture is initially recorded at cost, that you have to remember. Equity method required investment in associate and joint to be adjusted for invested share of post-acquisition equity of the equity of the associate. Only the post-profit will be taken into the account. The investor's share of current profit or losses associate and joint venture is disclosed as a separate line item in the profit and loss. And same thing, share of comprehensive income, separate item in the other comprehensive income. Where the dividends are paid or declared by the associate and joint venture, the investor does not prepare consolidated financial year. No dividend revenue is recognized by the investor. Where dividends an associate venture and the investor prepares consolidated dividend revenue account is prepared, but this dividend revenue account will be set off when the cash is there. Okay. Applying the equity method, of course, equity method goodwill calculation also I will just introduce and finish it off with that. Suppose this is the 25% and investment is so much and share capital, general reserve. So how do you calculate? You take you consider the assets are in terms of fair value net assets, and according to this uh, except 10,000 greater and the inventory 5,000. So we have to bring those new values to the books. So what happened is equity increasing. So thereby 10, 100,000, 50,000, 2,000 given equity and increase by 10,000 and 50,000. Tax rate is given. So thereby 1 minus 3 and altogether net assets at fair value. So much you take 25% and 25% is that much. This is the fair value of the investor's portion, and this is the purchase consideration. This minus this, you get the goodwill. But we are not opening a separate account for goodwill. But what we are trying to do is we should know that in our valuation, in our investment, in our purchase consideration, uh, either goodwill or excess. That means the negative goodwill may include. So in this example, we know that this particular investment includes this much of goodwill. Uh, then the depreciation, of course, in the next years has to be adjusted because depreciation now, when you increase the assets by 10,000, so depreciation is there. It says the further 5 years life. So 5 years life means 20%. This will have an impact on after the acquisition date. 1,400 is the impact of pre-acquisition adjustments. Here the inventory of 5,000 next year it will be open. It will have an impact on next the current year. So the thing is this: 15,000 is the given profit for the particular business. Is it given? Here 15,000 is the current year profit, and from that profit you have to deduct the depreciation, additional depreciation required for the revaluation, and also sales of inventory 3,500. The closing inventory become the opening inventory this year, so thereby opening inventory increase will reduce the profit, so thereby you have to reduce the profit by this much. So thereby investment share of profit is so much, 25%, and that will be debited the investment in recorded, and share of lost profit on the venture. So that's how about the goodwill and the equity methods. And also, if there is a excess goodwill, that means the negative goodwill. Now you see, 25% is so much, and we assume that investment is 45,000, not the earlier figure. So thereby there is excess. What happens is we have to charge the full excess to the P&L when calculating the share of profit. So thereby, so you just deduct, you take the 25%, from that 20%, 220 deduct, this would be the share of profit. So that would be the double entry. Investment in recorder, investment in associate, and and creditor to this one. Thank you very much. So what I did was I recorded this again because I lost the recording. Anyway, thank you.